Get Rich Education is brought to you by Ridge Lending Group, the Real Asset Investor, and Norada Real Estate. Cash flow real estate investors, this is Get Rich Education's Keith Weinhold. Did you know that you can finance up to 35 income properties all with one lender? Ridge Lending Group specializes in investment property loans, and they do it in almost every U.S. state. Ridge has worked with tens of thousands of real estate investors and homeowners all over the country. They've been doing this for investors for so long that at this point, they've helped more families realize their dreams of becoming real estate investors than any other mortgage lender in the country. To find out more, visit ridgelendinggroup.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to GRE. This is Get Rich Education, episode 116. I'm your host, Keith Weinhold, and this is the last episode of the year. We're going to talk with Tom Wheelwright about Donald Trump's tax plan today and how that affects you as both a citizen and you as a real estate investor. And, well, before we look ahead, let's look at the last 12 months that have brought us to the present day here at year end. Real estate prices nationally have seen very healthy growth this year. The Case-Shiller 20-City Housing Price Index, yes, it has some limits in its usefulness, but as a gauge, real estate prices are up 5.1% year over year, and that's for the latest quarter ended, which was back to September 30th. And I sent you all those stats in a recent newsletter so that you could see the city-by-city breakdown for yourself. Now, of course, let's talk about you. If your real estate portfolio is leveraged at, say, 4-to-1, then your gain from the 5.1% appreciation, well, you can multiply that by 4. That's a 20.4% appreciation rate in the amount that you have invested, and your 20.4% gain, as you know, as a Get Rich Education listener, that 20.4% gain is one of just 5 profit centers that you simultaneously realize with your leveraged cash flowing real estate. Congratulations! We spend most of our time talking about real estate here at Get Rich Education since that's where ordinary people can create real, durable wealth. With a few days left before the end of the year, it looks like the stock market, as measured by the S&P 500, is going to notch an annual gain of 10% or 12%, somewhere in that range. And as we've discussed before, that gain is unleveraged, and your real rate of return from the stock market, after you adjust for inflation, after you adjust for taxes, after you adjust for emotion, and after you adjust for all fees, your return is 0 or often even less than 0. Gold spiked to over $1,350 per ounce in the middle of this year. It's fallen since then. And here, a few days before the end of the year, gold is up about 5% year to date. Silver has had much the same path that gold has for 2016, although it's probably not going to end up quite as much as gold has. And take note that those precious metals price trends are denominated in U.S. dollars. We need to keep that in mind. And what about the strength of the dollar? Well, although it's strengthened pretty considerably over the last 5 years, the dollar ends this year about where it began, and the dollar's annual strength chart, that saw kind of a U-shaped path, a chart that was in the shape of the letter U, where gold and silver saw the inverse of a U. Gold and silver saw a hump, which makes sense when you think about the dollar's inverse relationship with metals prices. A strong dollar means that it takes fewer dollars to buy 1 ounce of gold or 1 ounce of silver, so that makes metals prices lower in dollar-denominated terms. What about interest rates? This month we had a December rate hike, a rate increase of 0.25%. And we also had a raise last December at this time of 0.25%. The federal funds target rate is now up in a range of 0.5% to 0.75%, still historically quite low. Remember, mortgage interest rates do not move in lockstep with the federal funds rate. Most people think that it does. It doesn't. In fact, when Grandma Yellen raised the Fed rate 1/4 of a point a year ago, mortgage rates soon went down. What about the rate of inflation? It ticked up this year at a faster rate than a few of the prior years, but it's still relatively tame. Autonomous cars have hit the streets of Pittsburgh as self-driving Ford Fusions make up this self-driving taxi service, and this is going to have massive implications for real estate. I dedicated an entire episode to that topic 2 years ago in episode 13. This is the year where we saw the formal inclusion of the Chinese currency, the yuan, into the International Monetary Fund's special drawing rights basket back on September 30th. This is a year where we had some real surprises, like the UK's Brexit vote and like the US presidential vote. Yes, we have a real estate guy in the White House. That's what our guest and I are going to discuss today. With Trump, him being pro-business is typically pro-inflation, and pro-inflation is typically good for leveraged real estate investors like us, as inflation destroys the burden of our debt over time. And we've had a lot of notable guests here on Get Rich Education this year, like Robert Kiyosaki and like Harry Dent, who made some wrong predictions. There's still a few days left in this year, but it looks like Robert Kiyosaki's long-touted prediction of a 2016 economic meltdown will not come true. But if it occurs in 2017, then how wrong was Robert really? With Donald Trump's election, Harry Dent no longer thinks that a stock market crash is imminent. Yes, he's changed his tune on that, okay? He doesn't think that's going to happen in 2017, although Harry Dent does think that the market is acting irrationally. He now admits he got the timing wrong. And not that these guys are necessarily such gloom and doomers, but you know what I think about gloom and doom sentiment. Here's what I think. People have basically been predicting the end of the world since the beginning of the world. Well, of course, eventually the Peter Schiffs and Harry Dents of the world are going to be right. But look, historically, times of prosperity have a longer duration than these shorter bouts of recession and depression do. They're outlasted by prosperous times. So have a small escape plan for tough times. I invest internationally and that I have about 1.5% of my net worth in precious metals, but I'm mostly investing in United States cash flowing real estate because that's where the real wealth is historically created. Well, what about the future of the greatest expense in your life, taxes? Let's talk about that now. Today, we have a flat-out tax genius on the show. You know who he is because he's a regular contributor here at Get Rich Education. He's the founder and visionary of Provision Wealth, based in Tempe, Arizona, the top tax planning firm on the planet. His firm handles the taxes for Robert Kiyosaki and, well, for me too, among other clients. And he and I are both contributing writers to the Rich Dad Advisors blog. We write articles alongside each other there at richdadadvisors.com. He's the best-selling author of the book Tax-Free Wealth. And by the way, that's the only tax book I've ever been able to read from cover to cover because he has a unique ability to make taxes interesting and even a little stimulating. Welcome back to Get Rich Education for your record-tying 5th appearance, Rich Dad Advisor Tom Wheelwright.
Hey, thanks, Keith. It's always a pleasure to be on your show. Always a pleasure to be talking to a great audience of real estate investors.
Yeah, thanks, Tom. Now, one of those articles that you recently published alongside mine over there at richdadadvisors.com is 5 predictions for a Trump tax plan. Tell us about that.
So I actually have to go back a little bit. I was in the National Tax Office of what is now Ernst Young from 1985 to 1988, which was coincidentally the last time we had major tax reform in the U.S. So I was there during the Reagan tax years. The Trump tax plan is remarkably similar to the Reagan tax plan. And I think that we can look at what might happen with Trump. Really, I think the best place to start is what happened with Reagan. I think we have to consider that what Trump does during the first 100 days is going to have a big impact. I mean, you think that Obama, his first 100 days, what did he pass? He passed the Affordable Care Act, which we fondly call Obamacare, fondly or not so fondly. Trump's going to pass tax legislation in his first 100 days. Now, Reagan did also. The 1981 Tax Act was passed in that first 100 days. That was part of Ronald Reagan's platform. Remember, the economy was similar. It was coming out of a difficult time. It was actually probably in ways worse then and ways worse now. Now we have this irrational exuberance going on, so it's a little different that way. But in the stock market anyway.
And the Trump rally in the stock market.
Yeah, exactly. We have quite a rally here, so we'll see what goes on with that. But in any case, what we didn't see to keep in mind is Trump's got this huge tax reform plan. And remember that Reagan became president in 1981. His tax reform did not happen until his second term. And I think that we can absolutely plan that Trump's tax reform, and I want to distinguish between tax reform and tax legislation. His tax reform, which means, broadening the base and flattening the tax rates, going to 3 tax rates, exempting the first 50,000, all of that, that's not going to happen during his first 100 days. I mean, let's be really clear about that. That will probably not happen unless he's elected to a second term. There's just a lot of other things going on. He does have certain things that he wants to have happen in the first 100 days. I think there is certain legislation tax legislation that will happen in the first 100 days. I do not think it will be individual personal income tax reform. So that is my first prediction, is that we will not have personal or individual income tax reform. What we have to look at is what issues did Trump run on and what are the big issues in our economy right now. And our biggest issue right now is international competitiveness, in my opinion, at least from a tax standpoint. Our biggest issue is international competitiveness. And if you don't mind, Keith, let me just kind of explain why this is an issue, because I think very few people understand this. I think that Paul Ryan understands it, which I think is a good sign, frankly, is when the Speaker of the House actually understands tax policy. This is probably the first Speaker in the House in many, many years, since probably the 1980s, 70s, 80s, that we've had a Speaker of the House who understood tax policy. And obviously, Donald Trump himself understands tax policy much better than maybe any president we've ever had, just because he's a business owner, right? He's a business owner, real estate investor, so he's just in it more. So it's just had a bigger impact on him. And I think he understands, as we've said on the show before, is that Trump understands that the tax law is a series of incentives and that they're intentional incentives to produce the results or to try to produce the results that the government wants to produce, whether it's, energy development. We can't, just some of the things that won't happen next year. Tax rates won't go up. I mean, I think everybody knows that, right? So tax rates are not going up next year. Don't worry about that. Number 2, Obama in his budget every year since before he became president, every year his proposal was to eliminate the oil and gas tax benefits. Not going to happen. Okay. Clearly not going to happen, especially when you look at who he's appointed as to environmental.
Yeah, it's pretty interesting and astounding, really.
I mean, that's a pretty astounding, actually, to put in an anti-environmentalist in that position. And he's very pro-energy, obviously. And he's from Oklahoma. So he's from oil and gas land, right? So what we do know is that the oil and gas people have got to be thrilled right now with what's going on as Trump builds his administration. We're not going to see that one go away. If anything, that one could be expanded. So that's something that I would look for. Now, these are things that could happen in the first 100 days because remember, these are little things. They're not major legislation. The major legislation is reducing tax rates, et cetera, et cetera. The little things like oil and gas, that could. I mean, they could give a tweak to it. They don't really want to stimulate production right now. What they want to do is stimulate prices. So how they'll do that will be interesting to see. But at the same time, that's something that won't happen. Another thing that's interesting is the carried interest rule. Maybe I should explain, Keith. Do you think I should explain carried interest for people?
Yeah, definitely. That's not top of mind for a lot of people. Go ahead.
And it's something that's very important for real estate investors. Let's say that you are putting together a real estate development. Maybe you're buying an apartment complex. Maybe you're buying commercial property and you need investors. And so what you do is you go, look, investors, we're going to go do this project. We're going to give you most of the money, if not all of the money, for the first few years. And the way it's going to work is we're not going to take our money as the developer until we actually sell the project. You're going to get all your money back before we take a dime. then when we sell a project, we're going to get a big percentage. We may get 25%, we may get 35%, we may get 50%. I've seen ones that go up to 60, 70%. But don't worry, you'll have your money back before we get anything. We'll take most of the risk, okay? And in exchange, we're going to do the work. I mean, they're going to charge administrative fees along the way, but we're going to take our profit on the back end. So we're going to carry our profit. That's why it's called a carried interest, okay? Now, what happens when you sell a building? What kind of gain is that? Well, that's capital gain. So what they've got is, we call it remember, all of these, a real estate investment, it's going to be a partnership for tax purposes. Well, remember, partnership's a flow-through entity, and we look at the gain based on what happened inside the partnership. And on top of that, we actually have two different types of ownership. We have an ownership of capital, and we have ownership of profit, okay? And we can split them. We can't do that in a corporation, which is why we use partnerships. One of the reasons we use partnerships for real estate. So I think that as a real estate investor, if you're ever going to raise money, you're going to want to have a carried interest, because what you're doing is you're actually you're working for that carried interest. And normally when you expend labor in exchange for money, that's ordinary income to Social Security taxes, and it's subject to your highest personal tax rates, up to 40%. But if it's a carried interest, it's capital gain. So your tax rates are basically half of what they would be. Well, there have been proposals for the last several years to eliminate the carried interest. And during the campaign, both Donald Trump and Hillary Clinton, and frankly, just about everybody else who was running, said we need to eliminate the carried interest. Well, they're not doing this because of a few real estate investors. They're doing this because the private equity firms, right, the Bain Capitals of the world, this is, Romney, et cetera, they have found a way to develop a carried interest for them. And so where it originally a carried interest was intended really for the real estate industry, it was a real estate tax benefit, it has now become a benefit for Wall Street. And that's why the proposal to eliminate carried interest. There's been a lot of fight against it. They've been able to defeat it over the last couple of years. We'll see what happens. I don't know that that's going to happen. It's certainly not going to happen in the short run. If it does happen, it would probably be part of the bigger tax reform. So I'm not as worried this year about losing the carried interest rule. So I think that's a big deal for real estate investors. Plus, I don't think we're going to see negative changes or anti-real estate changes to any of the real estate law. Obviously, one thing that our listeners may not know, Keith, is that, I think everybody's familiar with the real estate professional rule. You were talking earlier before we started about being a real estate professional, which allows you to take your losses from your real estate rental, right? Which is one of the great tax benefits of real estate from depreciation. I only learned this about 5-6 months ago. One of the primary lobbyists for the real estate professional, because when the passive loss rules were enacted in 1986, there was no real estate professional exception. That did not happen until 1993, 7 years later. Donald Trump was one of the biggest lobbyists. It was his company that was heavy lobbying to get the real estate professional rule in.
I didn't realize that.
Yep. So that's why I say, you're not going to lose that kind of a rule because it would hurt him, right? So he does have a conflict of interest. Frankly, all presidents have a conflict of interest by definition. He has more obvious conflicts of interest, and he's just not going to do it. So he's pro-business. He's pro-real estate. We may see an acceleration of depreciation. That was the first thing Ronald Reagan did in 1981 I don't know if Keith, you're young, so you probably don't remember even 1981 at all. Were you even born in 1981?
I was born, but yeah, I sure don't remember it so well.
So what happened in 1981 is, now we have depreciation rates for residential and commercial real estate are 27.5 to 39 years for the building. He made it 18 years in 1981. It was an 18-year depreciation schedule on real estate in 1981, and it was accelerated. It wasn't straight line like it is now. So you could see if Trump says we need more real estate development because that's infrastructure, right? He's talked a lot about infrastructure. You could see some depreciation changes, but they would be favorable. And what that would mean is that really it's your buildings that would get a faster depreciation rate. We already have a proposal, and here's another proposal that I think we will see. We will see an expensing allowance for all business acquisitions, not real estate, but all personal property. So what that means is that right now we have a 179 deduction. Well, we're limited in real estate on 179 because we typically have losses from real estate, right? I mean, from a tax standpoint, if we're leveraging our real estate, we're going to have a tax loss. We can't take a 179 if we have a loss. However, if we have a loss, we can still take an expense if it's just an expense and it's not a 179. So whether they put it in 179 and just make 179 unlimited, whether they change it so you're not limited if you have a loss, but I think that proposal is going to go through. Whether they will hold off for tax reform to do it or whether they'll put it this first year, my guess is that's more likely to happen right away. So an expensing election and the ability to expense any equipment. Now that includes dishwashers, presumably. It's going to include, so what you're going to want to do is you're going to go and do a cost segregation, which we've talked about before. And you're going to want to expense then everything that is considered personal property, not attached to the real estate. So that would be huge for the real estate industry.
Right. So we're talking about accelerating our deductions and getting greater tax deductions each year for real estate investors. And yes, I was barely alive in 1981, but I have been investing in income property for more than 14 years. And, during these 14 plus years of me investing in income property, sometimes you'd hear these little blips come and go like, well, the mortgage interest reduction is threatened or it could be capped or the 1031 tax deferred exchange could be disappearing. But now for real estate investors, it looks like the next 4 to 8 years, things are going to be tilting the other direction, more likely toward us rather than away from us.
I would agree with that. I think we're getting a limit on itemized deductions. Now, I don't think it'll happen in the first 100 days. I think that's more likely to happen with tax reform because that's a revenue raiser and they're going to need revenue raisers when they do the tax reform. So whether we get that cap, they're talking about a $200,000 cap, which doesn't affect a lot of people, frankly. Not a lot of people have $200,000 of itemized deductions. But at the same time, when they do that, they're talking about eliminating real estate taxes on your residences. Not on your investment property, but on your residences. They're talking about eliminating state income taxes, which should not be deductible in the first place. I mean, that's just a gift to California and New York is all that is right now. And investment expenses. So what they're looking at is only allowing mortgage interest and charitable contributions as itemized deductions and then capping the total at $200,000 or at a 28% rate or someplace they'll cap it. And that's been proposed for years and years. So when you see a proposal that's going on for years and years, you just got to believe that it's going to happen at some point. Now, whether it will happen this coming year, in order to offset some of the losses from the legislation that I haven't gotten into that will happen this year, or whether they will save it for the tax reform that they do later, the personal tax reform, I don't know that. Okay, but I think we will see. I think we've seen it in the past. The P's cap with some people are subject to that 15% haircut. It's called the Pease because Pease was the congressman who suggested it, where you actually have a haircut on your itemized deductions. We've seen that before. It actually came in, went out, came back in. It's there right now. I think we're going to see a cap. It actually makes sense to do a cap there. It's an easy revenue raiser. So at the same time, I think they'll eliminate the alternative minimum tax, which people in California know that the alternative minimum tax primarily right now, it hits people because of the state income tax. And so they're not getting it anyway. They're not getting the benefit anyway. They're in the alternative minimum tax. So it's not a big deal to lose that deduction. I think those things will happen, whether they happen this time or not. I don't know. What will happen is the corporate tax reform. So that's what we're going to see. We're going to see corporate tax reform because the challenge we have in this country is that we are at a severe disadvantage in the cost of our goods that we export as a result of taxes. We are at a severe disadvantage. And do we have time that I can give you an example, Keith?
Yeah, give us one.
Okay. So let's say you have Boeing in the news lately. Trump was all over Boeing. Let's say you have Boeing, and let's say you have Airbus. So Boeing's in the U.S., Airbus is in France. Remember that in most countries, like France, the corporate tax rate is around 25%. In the U.S., our corporate tax rate is 35%, plus there's a double tax because there's a tax on dividends and there's no deduction for dividends.
We have the highest corporate tax rates in the world.
By far. Actually, it's not even close. And I've been to about 20 countries this year. I've literally traveled around the world 3 times this year. And I always look at, the tax laws of any country I go to, of course. It's not even close. There's nobody else over 30%. Literally, we're closer to 50% when you include state taxes and you include the double tax. So we're right around 50% right now. And now, so take a Boeing, they sell an airplane, plus we're taxed on worldwide income. So take Boeing and they sell to France. Let's say they sell an airplane to Air France. Not that Air France would buy one, but let's say that they sell one to Air France. Boeing's going to pay income tax at 50% rate, right? Because they're going to pay the corporate income tax in the U.S. Now, France is going to charge them a value-added tax of 22%. So on top of the 50% tax rate, France is going to charge a 22% tax rate, value-added tax. Let's go the other direction. You have Airbus located in Toulouse, France, and Airbus sells to United. Airbus then pays no value-added tax because there's no value-added tax on an export, and they're only paying a 25% rate, not subject to the U.S. rate. So think about how big a difference that is. It's almost half. You're almost doubling the cost, almost, not quite, but you're almost doubling the cost of an airplane built by Boeing sold into France from the French standpoint versus the Airbus being sold into the U.S.
Yeah, that is just staggering. And I have this vision of Tom lying on his chaise lounge in the French Riviera reading a book about French taxes right now. That's what I think you do when you're over there.
Actually, I was in Paris. I was not the French Riviera. I actually have never been there. It's terrible. I spent so much time. I love France, but I was 10 days in Paris this year.
Well, 3 weeks from today, Donald J. Trump will be inaugurated as the 45th president of the United States. Some people like his politics, some don't, but many of us as real estate investors are pretty interested and I guess hopeful about how he's going to be good for us. We're going to talk about that more when we come back. You're listening to Get Rich Education. Our guest is Rich Dad Advisor Tom Wheelwright. More when we come back. I'm your host, Keith Weinhold.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's NORADA realestate.com.
As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
This is Rich Dad, Poor Dad, author of Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
Welcome back to Get Rich Education with our guest, Rich Dad Advisor Tom Wheelwright. So, Tom, what is Donald Trump expected to do with that corporate tax disparity?
So here's what we know. Trump has said he wants a 15% business tax rate, which would actually include real estate investors because it would include 15% of all business, not just corporate business. So here's what we know. The House is looking at a 20% rate, and Trump's looking at a 15% rate. What's going to happen for sure is we're going to get somewhere in a 20 to 25% corporate tax rate. Whether that will apply to flow-through entities like partnerships and S corporations, we don't know. But it will apply to corporations. That will happen the first 100 days. We will also get international tax relief. So whether that is water's edge meaning that if you sell outside the U.S., on my Boeing example, you would now no longer be taxed in the U.S. because you're selling overseas. Okay, that's a water's edge. Most countries have a water's edge, meaning that they don't tax you if you sell overseas. They don't tax that export. So that would be helpful. And the other thing we'll see an amnesty. So we'll see an amnesty for the Googles and Apples of the world to bring their money back into the U.S. That'll actually be a revenue raiser. That will be a revenue raiser because that money's never expected to come back to the U.S., and now they're going to build it in. And what you're going to see is you're going to see a $200 billion is because it's 10% on $2 trillion. So you're going to see this $200 billion revenue raiser that's going to be, in effect, a tax amnesty. But it'll be a revenue raiser when they do the calculation.
Yeah, well, that would be pretty dramatic. And, let me ask, Tom, if you have a quick answer. I just wondered what you think about this. If the United States has had the highest corporate tax rate in the world all this time, why are we one of the most prosperous nations in the world all this time?
Because we can print money as much as we want because the other countries are required to buy their oil with dollars.
Yeah, we have the reserve currency of the world. We have the world's strongest military.
The dollar's really strong right now. I mean, I think the dollar index is over 100% right now. That's really strong. I mean, the last 8 years, it's been as low as in like 90, 91, 92. So we have a very strong dollar, which makes it hard to sell too. And there's actually some argument that even if you give tax breaks, you're still going to have a problem with this, that it'll be made up by a stronger dollar. But I don't think so. I think the tax changes, not only are they needed, but they will actually attract companies into the U.S. because this is what people don't understand, is that it's not just about being competitive with the rest of the world in our exports. It's about bringing other companies to the U.S. What company would want to headquarter in the U.S. when you've got a 50% tax?
Absolutely.
Who'd want to do that? So now I think at a 20% tax rate, we're a tax haven. I mean, think about that. We're a tax haven. When you look at Ireland, which now their whole economy is built on being a tax haven. That's why they've got a good economy over there, is because Google, Apple, et cetera, they all went over there in order to get those great tax breaks. You put a 20% tax break in the U.S., which is the biggest economy by far in the world. I mean, nobody's even close to how big our economy is. If you put tax break like that here, you're going to have companies from Europe in particular, maybe not as much from Asia, but certainly from Europe. You're going to have them move their headquarters to the U.S. So you're going to have actually a big influx of jobs not because anything else, but that you're selling a lot to the U.S. anyway. It's cheaper if you make it in the U.S. because you don't have the shipping charges, but now you've reduced your taxes because remember, most countries, even if they retain in those other countries, let's say a German country, let's say, for example, a Volkswagen, which is one of the biggest companies in Germany. They own Porsche, they own all these other car manufacturers. Let's say they were to move to the U.S. They sell so many of their cars in the U.S. that it would make some sense if they had a low tax rate, because Germany has like a 70% tax rate when you combine all their taxes. Now you're moving to a 20% tax rate. Why wouldn't you? So I just think first 100 days, you're going to see the corporate tax changes.
Yeah, that would be a complete game changer. But, that really brings up one question here, and that is, how will the Trump administration pay for de facto tax reduction?
You know what? They'll pay for it exactly the same way that Bush paid for it and that Obama paid for it. Debt. That's how they'll pay for it. They'll just print more money. Yeah. It's the only way. To think that growth can pay for it is la land. It's just not possible. Just not going to happen. We're not an emerging nation. So we're not going to have 10% growth like China did for several years. That only happens in an emerging nation. It's like, think about a business. You start out in a business. People go, yeah, I doubled my business. Well, my very first year, I doubled my business too. I went from 2 clients to 4 clients. Seriously. So it's easy to double your business when you're small.
Right.
But when you get to be big, you're not doubling your business. You can't possibly double your business. So you've got a smaller percentage increment. You still got a big dollar increment, but it's a smaller percentage increment. And that's the same with the U.S. GDP. There's no way that you're going to get 5, 6, or even 4. I mean, even 4% is a huge stretch, that kind of growth.
There's a significant lag effect to this, too. If businesses are effectively onshored and we do get growth, there's such a lag effect that maybe the next administration would get the credit for it.
It's very possible. And, in the meantime, let's think about how big the chances are of a crash in the meantime. Actually, if the crash happened fast, it would benefit Trump and the Republicans, but it would have to happen next year. So Trump has an interesting dilemma. We're at an all-time high in the stock market. If you look at 2016 Dow Jones chart and you compare it to 1928, they're almost identical. So the chances of a crash, it's not a matter of if, it's a matter of when.
And Tom is there citing the year prior to the Great Depression.
That's correct. Thank you for clarifying that. Not even I was born in 1928. Okay. Close, but not quite. So what we're seeing is we got this irrational exuberance. You see it. I mean, we see it in the real estate market right now. I mean, you've got Class B rental properties going at a 4 cap rate. I mean, are you kidding me?
Oh, sure. We got price to earnings ratios of stocks in the hundreds, several of them.
It's crazy. So we've got more irrational exuberance in the stock market than the real estate market. The question is, if we saw a crash early, maybe not first 100 days, then Trump could actually say that was the fault of the Obama administration. We're going to fix it. So it would be actually, I think, positive for him to have a crash early in his administration. However, he may go, well, we're going to push this out. We think we can push this for 4 years. If he thinks he can push it for 4 years, then what happens if we have a crash a year and a half from now? The Republicans lose the House and they lose the Senate. If we have one right before the next election, the Republicans lose their control. That's a big deal for Trump, because if he loses control, if he doesn't have control of the House, there's no way he gets any legislation through because the Democrats hate him. You know, it's like Obama, any legislation he didn't get through in the first 2 years, he never got through because after the first 2 years, he lost control of Congress. So it'll be interesting. It's just fascinating to watch. I know none of us have control over it, but I always look at, okay, what do we do about it? And we have to be prepared for it. So I think we have to be prepared for everything continue to do well, but I also think we have to be prepared for a crash.
Well, I would love to have Donald Trump here on Get Rich Education with us, but now I think he's going to be pretty busy for a while. So one thing that President-elect Trump said about you is this: Tom is a member of my hand-picked team of wealth creation experts, the best of the best from all over the world. That's what Donald Trump said about you. That's got to be pretty flattering. Tom, any final thought on Trump tax plan and what we can expect as citizens and as real estate investors?
I would look at it this way. We're right at the end of the year here. So if that's the case, maybe we want to, if we can still accelerate some expenses into this year, maybe want to push some income into next year if we can. Okay. Got to do it legitimately. But there are some things, even on December 31st, there are some things you can do tax planning wise. So I would make sure that if you haven't done already, and if your accountant is not on vacation, give him a call, because there may be some things you can do thinking about Trump's tax plan. What might be coming? Tax rates aren't going up. So do I need to get more tax benefits this year than I might normally? Even if it's, let's say I decide I'm going to donate some appreciated stock, you can do that on December 31st at, 10 p.m. Donate appreciated stock. If you're thinking about donating, if you're still thinking about donating before the end of the year, that appreciated stock with the stock market so high, it's a really good time to do it.
Yeah, that's a really creative spin. Well, Tom, who's your typical client over there at Provision Wealth?
We work primarily with real estate investors and business owners. In fact, we only work with real estate investors and business owners. When I started this firm 22 years ago, my goal was to provide very high-level tax consulting and business consulting to entrepreneurs. So it's the entrepreneur. It doesn't matter if you're just starting out. It doesn't matter if somebody has 10,000, units of real estate or big real estate developers, because we do handle very large real estate developers, closely held real estate developers. We just love entrepreneurs. So we just love the entrepreneur energy, just like yours, Keith. We love the entrepreneur energy. We love real estate. I mean, my partners and I all kind of grew up in the real estate industry from a tax standpoint. I was actually brought to Phoenix from the National Tax Office actually to be in charge of the real estate tax practice there in the Phoenix office. When I was hired into the Fortune 500 company, they just acquired a big real estate company, and that's why they brought me in there. So I love real estate. It's great. It's the best tax benefits on earth are in real estate. So even our entrepreneurs who are doctors own real estate. So that gives you an idea that we really are. Real estate's a real specialty in the tax area, and we love it.
We love it, and now we have a real estate investor in the White House. So, Tom, I think by now most of our listeners know. They've probably looked you up by now, but if they don't know, how can our listeners find out more about you?
They can either go to our website, taxfreewealthadvisor.com, taxfreewealthadvisor.com, or they can call us at 866-467-5809, 866-467-5809. And we're happy to talk to them. And if we're not a good solution, we'll tell you and we'll help you to get to the right place.
Tom Wheelwright, for better or for worse, we're about to embark on one of our most interesting presidencies in this nation's history. Thanks so much for coming back on to Get Rich Education.
Thank you, Keith. Anytime.
Yeah, well, tax rates are up long term, but apparently not during a Trump presidency. And I didn't realize that before talking to Tom today that Trump's company or group represented the lobbyists that got the real estate professional designation for us as real estate investors, a big win for serious real estate investors. Tom says that for sure we're getting a lowering of corporate tax rates and probably in Trump's first 100 days. And, you know, in a nutshell, here's what I think about taxes. I'm all for a lowering of tax rates and an increase in the number of taxpayers. Okay, we don't need higher taxes. We need a higher amount of taxpayers. That's a formula for a prosperous society right there. Well, thanks to our great contributors on the show here this year, including Robert Kiyosaki and so many of his Rich Dad advisors like Ken McElroy and Tom Wheelwright and Garrett Sutton that have come on here. And thanks to our economist contributors on the show here this year like Daniel Ammerman and Harry Dent. Thanks to the talented guests here, including Peter Zion, Garrett Gunderson, Mauricio Raul, David Campbell. Thanks to the mindset guru, T. Harvecker, all the savvy turnkey real estate providers that have come on, and just so many others that I can't even think of right now. Next week, which will be the first show of the new year, we've got a very actionable resource in one of the most opportunistic real estate markets of 2017. And there are just so many things about the future that you cannot control. Well, one that you can, and one that's educational, actionable, and even inspirational is our wealth building newsletter, which you should go get for free right now at GetRichEducation.com. That's one thing that you can control. Hey, big thanks to Team GRE that's been here with me since the beginning in 2014. Amazing. That's my developers, John Collins and Marcus Whelan, sound engineer Vidran Jampo, GetRichEducation.com's web designer, Nikon Roy. I'm your host, Keith Weinhold, and I'll be back next week, which is next year, to help you build your wealth. Now go out there and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.